Before you invest in T-bills, T-bonds or unit trust in Uganda, these are 5 things you must understand clearly. Because the truth is, most beginners are not afraid of investing. They are afraid of losing their money. In this video, I'm clearing all these questions. I noted them down here. First one, what if the government changes? 2, what about taxes in unit trust, T-bills and T-bonds? 3, why do unit trust returns look low? 4, what are the actual interest rates in T-bills and T-bonds? 5, which one should I start with? And what is the biggest risk nobody talks about? These are the questions that I've been getting. They are valid questions. Today, I'm answering all of them calmly, clearly, and without hype. This is Becky, and welcome back to Becky Brilliant Finance. Before we begin, this is the disclaimer. I'm a financial educator. I'm not personal financial advisor. Everything I'm sharing today is for educational purposes, based on research and experience. Your financial situation is unique, so always do your own research and consult a licensed financial advisor before you make a big investment decisions. First question, what if the government changes? This is the biggest fear, and this is a valid question. So the question is, what if the government changes? What can happen to my T-bills and bonds? Let's be clear. T-bonds and T-bills are state obligations, not political party products. When you buy them, you're lending the money to the government as a country, not specific leader. Leadership can change, but nation debt's obligations remain. Government do not disappear, but leadership changes. The state remains. Debt commitments remain. For investors to lose money completely, the country would have to default, meaning it officially fails to pay its debts. This is extremely serious, and it would affect banks, pension funds, insurance companies, investment funds, international investors, and entire country. It's not something that happens casually. What does this mean? Does it mean that it cannot? Does it mean that it is not risky? No. This doesn't mean it's zero risk. No investment is zero risk. But the government securities are considered the lowest risk investments in a country because they are backed by the government's ability to collect taxes and generate revenue. So the real risks are not political change. The real risks are inflation, interest rate changes, locking your money for long periods. If you still feel uncomfortable, that simply means you should choose investments you understand better and feel safer. Taxes and minimum amount you can start with. For T-bills, there is 20% withholding tax on interest earned. For T-bonds, a bond of below 10 years, there is withholding tax of 20% on interest earned. And a bond of 10 years and above, there is withholding tax of 10% on interest earned. For unit trust, in Uganda right now, they are tax-free. So before you start investing, you should know the taxes and your returns. In case you want to know more about T-bills and T-bonds, unit trust, I already made a video. Check the link in the description. For unit trust, right now in Uganda, you can start with, there are some fund managers, you can start with 1K, 10K, 50K, and 100K. Depends on the fund manager you're choosing. I already made video on investments you can start with just with 1K, 10K. You can check them out. For T-bills and T-bonds, you can start with 100K and you can invest in multiples of 100K. Meaning you can start with 100K, 200K, 300K, 1 million, 2 million, depends on your capacity. So if you have small capital, maybe below 100K, you can start with unit trust because there are some which you can start with 10K, 1K, and 50K. You can check all that out. Unit trusts are always easier to start with and you can easily understand them. Now let's look at the interest rates and returns. The question is, why a unit trust interest looks low sometimes? In Uganda, for unit trust, especially money market funds, depend heavily on government securities. And recently, the Bank of Uganda and Ministry of Finance have been working to lower domestic borrowing costs. When government borrowing rates fall, meaning returns on T-bills and T-bonds also fall. So what happens on unit trust, especially money market funds, meaning the interest rate is also going to fall. And because money market fund invest heavily on T-bills, T-bond and fixed deposits, their returns also adjust downwards. For example, recently, we have seen a decline in T-bonds compared to last year. So last year's interest rate was around 15 to 18%. So if the rates keep declining, it means we are going to see a change or a decline in unit trust rate. Last year it was around between 11 to 13%. So if we start seeing a decline in that, now you know the reason why the money market fund interests are low. That's why I always encourage, before you invest in anything, first understand how it works, where they invest, how they get interest, know your returns, know taxes. When you understand investment very well, it is easy for you to know the markets, to know when to invest and when not to invest, or where to invest and which investment to start with. Interest rates move based on inflation, central bank policy, government borrowing needs, and market demand. Rates can rise, rates can fall. That's how the system works. Which investment should a beginner start with? Now this one depends on your goal. But if someone is beginning to invest, the beginner ladder looks like this. Step 1, emergency fund. Step 2, money market funds. Step 3, T-bills. Step 4, T-bonds. Step 5, stock market or business expansion. Why? Because most beginners need simplicity, liquidity, and stability. Jumping into stock market without emotional discipline can be so stressful. For most beginners, start where you can easily withdraw your money. You can even sprint. You can put some money in money market fund for emergency. Then also, you put some money in a business you understand better. If you don't understand very well next investment, first learn more about that investment. By as you're learning, put your money in money market fund as it brings some interest on it than keeping your money idle. First build confidence before you start investing, then grow. The biggest risk is not even government change. It's not even taxes. The biggest risk beginners ignore is inflation, lack of consistency, and lack of understanding. Before you invest anything, even if 1 shilling, make sure you understand that investment. For example, if the investment interest rate is, let me say, 5% per year, and the inflation is 6%, it means you're not investing at all, because the inflation rate is higher than the interest rate you're going to get in that investment. And that's why understanding the real return matters. Risk 2, investing once and stopping. Financial freedom is built through consistency, patience, and compounding, not by chasing higher interest rate every year. Understand risk, understand taxes, and understand your real returns. Then invest. If you understand these 5 things better, you are already ahead of most beginners. Investment is not a hype. It's about structure, patience, and clarity. I have already created investment series from part 1 to part 5. You can check on them. By the end of them, you will have some understanding about some investments. I've linked all investment series. Check the description. If this helped you, share with someone who is afraid to start investing, because fear reduces when knowledge increases. Thank you for watching till the end. See you in my next video. Bye-bye.